Business financing, making smart borrowing decisions. Welcome to IO Insolvency Options with Darren Vardy, the Managing Director of Insolvency Options and a registered liquidator with over 30 years of experience helping businesses and individuals navigate financial challenges. In today's episode, Darren explores the world of business financing and reveals the hidden dangers of high-interest fintech loans. He explains why borrowing money to pay old debts without addressing root causes only kicks the can down the road, and shares strategies for choosing the right type of financing for your business needs. You'll learn about comparing interest rates, understanding when equipment finance makes sense versus renting, and identifying the real reasons behind cash flow problems before borrowing. I'm your co-host Anthony Perl. Let's dive into unlocking more about insolvency options. Darren, let's talk a little bit about business financing, because it is something that businesses undertake a fair bit, but do they actually understand it properly and the implications of it in situations where they find themselves not being able to repay it?
Yeah. So business financing, like anything, comes at a cost to business. You know, the interest payable by the business is an operating expense. And where a business is looking to be profitable and to turn around, we always look at the various expenses that can be, cut away or shaved down to make it profitable. In recent times, and with the advent of a lot of the fintech loans, we quite often find that these are such loans where business owners have got a cash flow issue. They're staying up late at night. They're Googling, how do I fix my cash flow? There'll be a number of loan providers who say that they're able to provide, unsecured loans for, within 24, 48 hours. Now, one of the real issues with those types of loans is that the interest percentage that the business ultimately pays. And that's leaving aside generally the personal guarantee that the director also provides. So a lot of these loans are high percentage loans, north of 20% per annum. And when you compare that to the other loan products on the market or loan types available to a business owner, that can be quite high. The majority of small to medium-sized businesses traditionally have been funded out of mortgage finance. And, mortgage rates are sitting at around the 6%. Again, a mortgage, directors are still personally liable. So if a person has equity in a mortgage, my recommendation generally always is look at that as an option, first option, because that will generally be your cheapest form of finance. A business may have some unencumbered equipment. So therefore, it may be possible to raise money on a lease buyback type arrangement against that unencumbered equipment. And, those equipment loans may be running somewhere between 8 and 15%. Again, a cheaper form of interest rate to some of those easier access loans that we spoke about earlier. And sometimes the amount of interest paid can be the difference between profit or loss. And because once we find is that it's really easy for business owners to access cash, certainly a lot harder for them to repay those debts in full. And more often than not, from what I've seen, they are borrowing money because they have a cash flow problem, but the business owners may not have actually identified what that cash flow problem is and what is the real reason behind it. So whilst they've borrowed money to deal with the payment of some of their suppliers and creditors, they've actually not dealt with the root of the problem. And if the root of the problem isn't dealt with, well, then that money will go out, and all business owners are doing is kicking the can down the road, weeks, maybe months, and end up in a very similar position.
Yeah, and I think it's a big lesson, isn't it? Because as a business owner, you can be blinded by the belief that it's all going to work out okay.
Correct. And, this is where getting back to, business owners really understanding their numbers and really understanding what that break-even position is. And quite often a business will need access to cash for expansion, but understanding why you need the cash and putting that cash towards something like expansion where you will reap the profitable rewards is as opposed to borrowing cash to retire old debt, which is a very different thing. And that's where borrowing cash to retire old debt solves the issue of the debt issue. It doesn't solve the underlying reason why you need the cash. And, you need to be looking at, are there some costs that we need to shave? Are there some unprofitable products that we're selling that we can simply stop selling? Are my customers using me as a bank? Are they taking longer than normal trade terms to pay me what I'm owed? So there are a number of different things that go into what makes up a cash flow issue. It's a matter of identifying and working out how to properly and appropriately address those issues.
Yeah, and I think these are little triggers that businesses should be pulling on a regular basis, right? And looking at those things and understanding that if they don't, it accumulates and you can find yourself in a real problem situation.
Correct.
But at the same time, the hard part is that these loans that you speak about, these 24-hour loans, they're everywhere and they're business owners' faces all the time and make it seem like it's easy and it's a great way to solve a problem.
And look, in circumstances, they are appropriate and they do work. If a person or a business owner requires some short-term cash for, say, a 3-month period to run a project through to see the income flow, there is a role for them in those instances, definitely. It's where these funds are actually being used to retire other debt and we're at the same time as a company trading at a loss where the issue starts to come through to the front.
And in your experience, how often do businesses actually find themselves in a situation that they're going south and I had no idea when it comes to these kinds of loans and things of the implication?
Those that have come across my desk, the majority, unfortunately. And that is because, and hindsight's a wonderful thing. And quite often the business owner will say, I didn't realize I had a problem until I had a problem. And the problem that I had was that I couldn't keep up the daily repayments of these loans. But realistically, they had a problem before they actually borrowed that money.
Yeah, that's the interesting part about it, isn't it? The borrowing the money is relatively easy in those sort of 24-hour turnaround things. And it doesn't necessarily encourage you to go and look hard at what the problems might be and how you might address them. And, because you can get caught up in that, I need the money and the relief that you've got the money and then just charge ahead without taking that time to go back.
The issue is that we often find is that the business owner needs the money to pay a debt. The problem is, why is there a debt there that needs to be paid? And that's really about asking the right questions is, why am I in this situation where I have debts that aren't paid, that I need to pay with urgent access to cash flow?
So, Darren, talk to me a little bit about then the different kinds of loans that you've seen that people have. And we talked about obviously these 24-hour loans, but, and you mentioned earlier about equipment finance and there's also trade finance as well. And I'm sure there are others that you're seeing. Is that part of the problem as well, that there's not a consistency in people understanding what's what and the various options, and sometimes there's 2 or 3 things that they've taken out?
Like anything, the type of financing needs to be appropriate to the business and to the business's needs. If a business is the type of business that employs a lot of capital, well, then it makes sense, and the capital equipment, it makes sense to structure up an equipment finance type facility so you can trade that equipment as you need to, sell, replace, and to build that rapport with an equipment financier. If your business issues a lot of invoicing, there's debtor factoring or invoice discounting, which allows you to bring the cash forward to then pay your suppliers and get the product in and out in a quicker manner. Again, depends on the nature of your business. What we've found with the invoice discounting or the factoring is that whilst you might pay a cost of interest to those organisations, you often benefit by using the funds to get a discount from your suppliers because you're paying them earlier. So it's all about what is your business and how you are best to employ the capital, be it loans or funds advanced by yourself, how that capital is best employed in your business to maximize its profitability.
Yeah, I mean, and that's the key, isn't it? And I imagine something like equipment's a good example where we often gravitate to wanting to go towards the latest and greatest, right? And all the bits and pieces and options that are in there. And you've got to balance that out, don't you, to make sure that you're not over financing on something that may not give you quite that extra return, even though you like the options that it might bring. Is it really worth it for the business? Because the implications are huge.
We see this in construction, and so that's called, say, a civil contractors. They use huge amounts of equipment, large dollar figure items. But when a project finishes and there may be a delay with the next project, if it comes on at all, you had these huge items of capital equipment sitting around idle. You're still paying for them. So, you really need to look at, do I buy, do I sell? Do I then, once I finish the project, do I then look at offloading this equipment, which then offloads the loan and the liability that goes with that? So it's really a matter of making sure you understand your business and not holding on to these items of equipment, because believe it or not, you can actually go back out and buy them again if you need them for another project. So it's really understanding that project that you're doing or projects that you're doing. And
Yeah, I mean, I think that's a really interesting idea, isn't it? Because often people go and, yes, great, we've got this particular project at the moment. We need this piece of equipment. It'll be great for us in the future. We buy the equipment. And then that project finishes. And now you're forcing yourself almost to be looking for equivalent projects, which may or may not be there, in order to be able to maintain the equipment that you've got, rather than saying, well, maybe we should have factored in from the beginning that we're going to have to sell the equipment at the end of this project, quite possibly, and factor in that there may be a loss associated with that slightly, but that should be part of the equation.
but that loss will be, I guess, planned and accounted for as as an offset to a part of the profits. So, it's really down to project planning and profitability targets.
Yeah, it's an interesting one. Because I've heard a similar story on a personal level where it's a bit like, rent or buy. And I remember hearing this story about someone that they went overseas and they were going to be driving around for a while, and it worked out cheaper for them to go and buy a car, a secondhand car, and at the end of the trip then sell that car again. Didn't sell it for quite as much as they bought it for in the first place, which is fine, but it was less than the rental of the car would have been for 3 or 4 months.
Correct. So you do have to weigh up all the various options. And that's your typical example of, well, let's plan, what are we doing? Where's my least cost going to be? And then going from there.
I think the question really is, to wrap this up a little bit, is for a business owner that's looking at taking out some kind of finance, what are the things that they need to be thinking about to make sure that they don't find themselves in a situation where this is going to cause them a huge problem not that far down the road?
Well, I guess the first thing is what do I need the equipment for? Do I have profitable projects for which the equipment will be employed for a long-term period? Because if they're not employed for a long-term period, maybe the cheaper option is to rent, as you indicated. But where a project generally extends sort of for 12, 18 months or longer, it may well be worth then to buy and finance. Okay. You then need to actually then look at, well, once that equipment is 5 years old, because here's the other side of the equation. A lot of businesses hold on to their equipment for a lot longer than they should, which leads into a repair and maintenance cost. And sometimes you need to retire the dinosaur and buy a new piece of equipment as opposed to spending the money on the repairs and maintenance of the business. So all these things need to be taken into consideration. The useful life of a lot of machinery will be known by the operators. What is that useful life? How am I going to maximize its value? And then what does it look like at the end of its useful life? And am I going to have enough projects to run that particular item of equipment through to the end of its useful life?
And I think just to finish off, similar principles apply if you're paying off debt as far as or needing access to finance for paying salaries and suppliers.
The salaries and suppliers finance is a little bit trickier. And I say that because if you are looking to borrow money to pay your salaries and to pay your suppliers, you've really got to ask the question, why? And why am I doing this? More often than not, it comes down to cash flow management. And if a business owner is looking to borrow money to pay its day-to-day, week-to-week, then again, that's a warning sign of poor cash flow management. So at that point in time, I would suggest that the brakes need to go on and say, well, we need to deal with the why. And in dealing with the why, we then borrow the money from the appropriate financier to address the why, which in turn will help pivot that business and get it back into hopefully a positive cash flow situation.
I think that's a lesson here with all of this, isn't it? It's being prepared for what might go south, but trying to do everything you can to prevent that.
Correct.
And that's all we have time for in this episode. Next time on IO Insolvency Options, we'll dive into risk management and insurance, protecting your business and family. Darren will explain why proper insurance coverage is your first line of defense against business failure and reveal the critical types of insurance that business owners often overlook. It's essential listening for business owners, directors, lawyers, and accountants. For details on how to get in touch with Darren and his team on insolvency challenges, please consult the show notes. This podcast is produced by my team at podcastdoneforyou.com.au, helping professionals share their expertise through powerful podcast content. If you found value in today's episode, please like, comment, and subscribe to IO Insolvency Options. Until next time, remember, there's always a way forward when you know your options.